Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're seeing heading into the final month of the year. The Federal Reserve began cutting the Fed funds rate in September. Normally, long-term Treasury yields are flat to down in the months that follow the start of a rate-cutting cycle. That's not the case this time. We think the Fed is underestimating the fact that the inflation rate bottomed in September just as they started a new rate-cutting cycle. A rising inflation rate is contributing to the 10 and 30-year Treasury yields moving higher, and it probably will prevent the Fed from cutting short-term rates much further. The US dollar began to rally in September too, and has continued to strengthen against other major currencies around the world. Currency strength or weakness has a lot to do with interest rate differential between countries and relative economic strength between countries. Major international markets like Europe, Japan, China, and emerging markets are all slowing faster than the US, and it's expected that their central banks will be more supportive by lowering interest rates than the United States. That contributes to a stronger US dollar trend that could continue into the middle of next year. The change in trend for the bond and currency markets has not stopped investor optimism about the stock market. This chart tracks the S&P 500 against its average earnings per share over the previous decade. There are 5 distinct periods when valuation became extreme. The previous 4 preceded bear markets, and we are currently in the 5th. Valuation multiple expansion has been a significant driver of the gains in the stock market this year. It could be that earnings growth drives gains next year, but we doubt that any more gains will come from higher valuation when we already are at such an extreme. Now the risk from an investor's psychology point of view is that optimism turns to pessimism over the next 1 to 2 years. Investec Research created this investor psychology barometer that measures the optimism or pessimism by investors in the stock market going back to 1997. Stocks are at a dangerous point whenever this psychology barometer makes a high peak and begins to move downward. Most of the time, stocks fell as investor optimism faded, and in the few cases where the S&P 500 still appreciated in value, the gains were small. It's not a good risk-reward ratio when optimism is this high. As a result, we believe it's important to focus on managing risk. Where does that leave an investor that's concerned about significant downside risk? There's still an attractive rate on the short-term Treasury yield. The Fed has cut short-term rates by 0.75% in the last 2 months, but the annualized 3-month Treasury yield is still 4.5%. That's a good starting point for generating a decent return, and it worked well for balanced investors the past 2 times that the 3-month yield was at this level during the dot-com bubble and the housing bubble. We hope that gives you a sense of what we're seeing across stocks, fixed income, and currencies. If you have any questions or would like to learn more about Oxbow, please contact us. We provide the information that we think is most valuable to investors. If you'd like to follow our work more closely, please subscribe to our YouTube channel.